Inplay Global is pioneering the first securities exchange for sports performance. So in the case of the NFL, we will have 32 individual companies that get securitized and brought to market under the SEC, and each of those companies will be in the business of tracking the performance of those teams. So in the case of the Chicago Bears, we would have InPlay Chicago Bears Inc. That company's business model is for every win that the Chicago Bears achieve on the field throughout the season, InPlay will pay them $5 per share. And so it's tracking the entire season, not just individual events around sports performance. It's allowing investors to invest at the beginning of the season and track that performance throughout the whole season, or they can trade in and out of those securities throughout the season, not just one event, one game.
How do these companies get capitalized?
These are going to be C Corp companies that we're going to bring public through Reg A Tier 2 offering, which allows us to raise up to $75 million per company per issuance. And so just like all companies that come public, there's an initial offering. That's how they're going to raise the capital. And then that capital gets put into those individual companies' treasuries. And then based on how those companies perform throughout the year, they may accrue more or less than what that cap raise was, based on the win rates on the field or in their sport.
How do the company's revenue models work?
The revenue model for the companies are for every win that they achieve on the field in the NFL, they will get $5 per share. If the Chicago Bears are projected to win 8 games at the beginning of the season, their initial offering price will begin at $40 per share. Now there's another revenue attribution on investor engagement, which will measure each week. So based on, the Chicago Bears just played the Minnesota Vikings. It was a very close game, a lot of back and forth turnovers and scoring plays. We would measure the investor fan engagement in that game of how many orders were coming in, how many trades were coming in, and how many participants are trading each of the teams. And at the end of the event, we'll allocate to each of those teams based on who had the higher proportion of investor engagement. So if the Bears had 60% of investor engagement, they'll get 60% of that allocation for that week. If the Vikings had 40%, they would get 40% of that engagement for that week. What that entitles those companies revenue-wise is even if they've lost the match or the game like the Minnesota Vikings did, they still got some revenue attributed to that game.
If you trade against your team, are you engaging with them or the opposition?
If you're shorting the Vikings, you're engaging for the Vikings in that scenario. Like if you think the Vikings are going to lose the game and you decide you no longer want to go long the Vikings and you want to short the Vikings, that's still engagement in the Vikings. There's still interest in the Vikings. It doesn't always have to be a positive upward momentum type engagement. It's who's trading that team company in that week.
Okay.
So think of it as which team companies are trading the most and how are they trading, and it's not just going to be on volume, it will be on order flow and participation as well.
What does it cost to borrow the shares?
We're still working out the commercials on what the cost structure will be for shorting or the transaction fees as well. It should be no different than how you short an equity market today. Like the cost structure shouldn't be any different. If the brokers are charging repo or charging some type of stock loan fee, it's really going to be negotiated through your brokers.
Who would be the natural users of this market?
Right now, there's really, to our research, a true risk management vehicle for sports trading or sports performance. Right now, just about in every other asset class out there or any other industry, there's some type of risk management tool at your disposal, whether it's insurance, derivatives, equity markets, other investment vehicles. But in sports, we do not see any risk management layer there. And so what our securities will allow for is any organization that is reliant on the success and the performance of a sports team can buy these equities as a measure of risk management. And so if you're, a garage owner that is relying on people showing up to the games every week and renting parking spots out of your garage, and all of a sudden that team doesn't do well, and you're not getting a lot of the participation or you're getting that return and revenue that you need, you can use our securities to offset some of that risk.
Why SEC rather than CFTC?
We've been developing this concept for over 4 years, 2 of that being regulatory diligence. And what we found is that an equity framework was really the right model to approach bringing sports securities to market, to enable investors for more long-term type investing and holding of these securities. And there's a lot of provisions in Reg A securities specifically that allows us to bring these to market, I don't want to say easier, but a lot more conducive to the way that investors want to trade in the markets today. I mean, you look at how many investors are in equities versus derivatives or other asset classes, and it dwarfs just about everything else. Everyone knows equities, knows the concept of buying shares in a company. Not everyone understands prediction markets yet. They're getting there. Not everybody wants to go trade other CFTC regulated markets because the access model may be prohibitive, the cost structure might be prohibited. There's a few other, rationales around not wanting to trade a market under the CFTC regime versus an SEC.
What will be the relationship between outside prediction markets and Inplay Global?
We actually see our performance securities helping to grow prediction market volumes and participation because we see prediction markets becoming the hedgeable instruments to our securities. As our performance securities launch and are traded, again, they're across an entire season. So in the case of the NFL, it's going to be across 17 weeks of play. Each week, you may want to put on a position in a prediction market to offset or arbitrage around that risk that you're exposed to on that investment, just like you would an index future against a stock portfolio or a fixed income future against an underlying fixed income asset.
What has the reaction been from some of the teams you've talked to?
The one thing about these securities is that they don't require or need any type of affiliation or approvals by the individual teams because we're using what's called the fair use doctrine that allows us to take any information in the public forum and create financial instruments or contracts around them. We have engaged with a couple of team owners or family offices that represent the teams, and they think this is a very innovative concept. They like the way that we've designed it. There's a lot of interest in potentially trading these securities depending on whatever access they have.
What other sports could be included?
We want to start in the spring with the NBA playoffs. So we're going to actually have 2 issuance of these team companies every season. One for the regular play and then one for the playoffs or the tournaments. There's different economic models for each issuance, so that's why we're doing 2 issuance a year. So our plan is to come to market in the spring with the NBA playoffs, and then the World Cup next summer will be our premier event. And then we will list securities on NFL football and D1 college football. We want to securitize the sports that are primarily going to be starting in the fall. We may do Major League Baseball playoffs, but we wouldn't do the full season the first year.
What are the unique variables and market surveillance issues?
So because these are securities regulated by FINRA and the SEC, they will have to follow all the same surveillance and market regulation policies that any other stock would. So we're going to have, AML, KYC requirements. We're going to have, technology regulatory requirements that we have to adhere to meet both SEC and FINRA standards. So we'll be launching as an ATS. So that requires FINRA approval, and then our securities will be regulated by the SEC.
How far along are you with regulatory approval?
We're anticipating early Q1 to have our approvals. Applications are pending now. Our broker-dealer application in FINRA is pending, which allows us to launch an ATS, and then with Reg A securities, we do an offering circular that needs to be qualified by the SEC.
What will the launch event look like?
We want to do a couple events around bringing these securities to the market as a primary offering because, again, these have to be initial offerings to the marketplace. There'll be a set initial price, which will give all investors the ability to buy these shares at issuance, not after issuance like most securities. And then we're planning a couple events around what we're kind of dubbing the in-play draft, or the ability to buy these securities when they become available for primary issuance.
What is your educational approach?
We actually see the launch of our performance securities as a great opportunity to enhance financial literacy around how a stock market works. We're going to launch our own app and content on our website that's going to produce videos and webinars around how these securities work, what's the process, what's the difference between a primary market and a secondary market, how companies are made public. A lot of this you only learn if you take a finance class in college or you look it up online because you're interested, but we're going to use this as a way to educate all investors on how stocks are created, how they're brought to market, how they should be valued and traded, and then pass that education on to hopefully our investors in our securities to be able to more effectively trade.